Right. Hi guys, I'm back in Malaysia, and well, I'm just gonna continue on what I do best, which is talk about some simple concepts of investing. So I went back and found my old book, The Intelligent Investor by Ben Graham, which is he was the mentor to Warren Buffett, and I just reread the book just to get some of the basic ideas of investing back into my head, and I just want to share with you guys what his definition of investing is. So these are Graham's word. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. And what all these mean is that you can cut this definition into three parts. First is thorough analysis, second is the safety of principal, and the third is adequate return. So let's just go real quick on what these three parts are. And as usual, I've already updated this on my blog if you want to read about it. So thorough analysis means that the idea of understanding the company that you're planning to invest in. Real simple, right? You want to understand how they make money, where they spend their money, what industry are they in, what's the management team. So all this information can be found in usually the annual reports or the 10K forms that are available through the SEC. The second part of this definition is the safety of principal. This is the idea that you're not investing to make money, but instead to not lose money. That should be the number one priority, as Warren Buffett made his famous first rule of investing: do not lose money. And the second rule is do not forget rule one. And that's because there are so many ways to get burned when you're investing, especially when you don't know what you're doing. So knowing what you don't know and trying to protect the downside is one of the most important things that you can do as an investor. And thirdly, adequate return. Now this is kind of controversial because a lot of people think that when you're investing, you want the highest return in the shortest amount of time. Well, this is frankly requires a lot of time, effort, and skill. And if you're not used to investing, if you're just starting out, adequate return is much more of a sane, logical, rational approach. Because if you want the highest return all the time, you can do this in a various amount of ways, but you need specialized knowledge in the security, the derivatives, the market, and it all depends on how much time and effort that you're willing to put into studying all these. Adequate return means that what are you investing for? Are you investing for your house? Or are you investing for a wedding, for college education? What's the time frame? 10, 20, 30 years? All this factor into the kind of returns that you would likely seek and the kind of investments that you will pick. So if you get anything out of this simple definition by what investing truly is that it's just being smart with your money. You don't want to mistake investing for gambling or speculation, even though that in the minds of people, a lot of people that I know, especially back here home, when I talk about stock investing, the Chinese use a phrase called do you play the market, which is I don't play the market. I actually invest. I look at the companies, I understand how they do business, and I buy them at the right price. Occasionally I do a little bit of side betting because that's just how I am. But when I'm actually gambling with the money, I know that I'm gambling, so I don't endanger myself into deluding that I can make a whole lot in a short amount of time. That is just not investing. Thank you for watching this video, and as usual, if you have any questions that you would like to ask me about the US market or investing principles in general, I'll be free to answer some of your questions to the best of my abilities. Thanks guys.